Hello, welcome to this week's Market Carver. I am Andrew Thrasher, Portfolio Manager for Financial Enhancement Group. I'm joined this week by Zach Unger, Senior Analyst for Financial Enhancement Group. We have two really interesting topics to discuss this week. The first one, looking at the impact central banks are having on gold. Is gold being manipulated by the central banks? We're going to look at that and look at the data behind it, whether that's true or not. Then Zach's going to dive into the cockroach theory. Not sure what that is? You're about to learn what it's about, and we're going to talk about some bank failures. All right, first up, let's talk about gold. Gold has had a phenomenal 2025. We've spent a lot of market covers talking about the importance of the Mag 7 stocks, how equities have been driven by technology and AI and what have you. But technology has been up roughly about 24% year to date. When we look at gold prices, gold's up 65% year to date. Actually, just since August, gold is up 30%. Gold's been really, really strong recently. And so it's starting to get a lot more attention in mainstream media. And we're starting to get more questions from families like yourself asking about what's going on with gold. They're also seeing headlines where central banks, federal governments are starting to buy up gold. And we're getting questions is the dollar is going to fail? Is that why we're buying all this gold? Why is the central banks hoarding gold? What's happening? And there's going to be some fear mongering and a lot of misinformation out there. And so like we do with most market covers, we want to give you the actual data, show you what's going on, and give you what we believe, rational take to what's going on behind some of the news stories you're seeing. So the first chart I want to share with you is looking at the World Forex foreign bank reserves of gold holdings. That's the blue line. The red line is gold prices. As you can see, central banks have been selling off a lot of their gold, and then it bottomed in 2009. Since then, central banks have been buying back a lot of their gold, or so it appears. You can see their reserves have been going up in the number of ounces per millions of ounces in gold, but so has the price of gold. And so this is the chart that we often see get shared in news stories showing, look at all the gold that central banks are accumulating. And in fact, they're accumulating over, at the bottom, it was 693 million troys ounces of gold. And since gold has done phenomenally well, their gold holdings have risen by about 20% since then. And so what we want to do, and what JP Morgan did a fantastic job with their data, is they started looking at what was the rise in the amount of gold they're holding because they were buying more, or is it just because gold prices have been going higher? So this next chart I'm going to show answers that question. And so what this chart shows, again, that blue line is showing the amount of gold that they're owning. The red line is showing if there was just no change in their holdings, if what they owned back in 2009 stayed static and the appreciation was just a result of the increase in price in gold. And as you can see, the two march pretty well together. They have been increasing some of their allocation, but you can see it's pretty marginal. Because of the share price of gold, it would have pretty much gone up 20% anyway. So while we are seeing central banks increase their exposure to gold, increasing their holdings, the increase has largely been driven just by the fact that gold prices have done really well over the last couple of years. We can see that if they had no change in gold prices, that gold line on the bottom, how it basically is pretty much flat. So we can see that there has been a marginal increase in the buying, but it's really driven by the price of gold. So no, we're not overly concerned with the fact that central banks are hoarding all the gold, or there's this going to be a foretelling of what's happening with the US dollar. We don't think any of that has a lot of data to back behind it. And so we think it's truly just been gold prices have done phenomenally well, and that's risen the actual amount of gold, the value of the gold held at central banks. Now I'm going to turn it over, speaking of banks, turn it over to Zach, who's going to talk about some of the other headlines that might be in front of you in the recent weeks.
I know you all are eager to learn about cockroach theory and what that means. But before we get into that, I thought it'd be helpful to set the stage of cockroach theory and why it's being used in the financial media right now by talking a little bit about market cycles and how they tend to play out, primarily because there's a pretty standard way in which they play out. Namely, what tends to happen, particularly in the credit market, is that you will have some sort of crisis event. Obviously, the great financial crisis is the big one that comes to mind, but it doesn't have to be big like that. Typically just events that cause panic for investors. So maybe a smaller scale one that comes to mind would be the regional bank crisis with Silicon Valley Bank a couple of years ago. So it can kind of be different magnitudes, but typically there's a crisis that occurs, and that crisis causes lenders, banks, investors like us, other folks of that nature to tighten the reins on their lending standard. What that means is that they're less apt to give out loans, and the loans that they do give out, they require more compensation on because they want to account for some of that risk. Well, over time, that crisis tends to fade further and further into the rear view, which means that lenders have to loosen their lending standards again in order to stay competitive in the market. Some lenders start to loosen, and so others have to follow suit in order to gain business. Those looser standards then tend to give way to another crisis, and the cycle repeats, so on and so forth. There are more nuances to the general market cycle, but that's kind of an overview that I think is a helpful backdrop. Specifically, as it relates to this and why cockroach theory is being used in the financial media right now, cockroach theory says that when one bad player comes to light, there are typically others that will follow or that will come to light in the future that just aren't seen yet. It's very similar to how you would interact with a cockroach. If you see one at your house, you can assume that there are probably others that you just can't see yet, and at some point you're going to find more. So that's what cockroach theory says. The reason it's being used in the financial media right now is because of some of the fraudulent activity that's taken place in the lending space. So the first one that came to light was Tricolor. Tricolor is an auto lender. They committed some fraud with how they were pledging assets in regards to the loans that they were taking on. They declared bankruptcy. Another player in the auto parts industry committed fraud and declared bankruptcy. And then the two most recent, the two that Andrew are referring to, are large regional banks, and their loans were unknowingly subordinated, meaning they're not at the top of the capital stack. They're not getting paid first. They were subordinated unknowingly to the banks, and it was because of fraudulent activity. What's evident in all this that's playing out, is that there have been some bad players taking advantage of some of the looser lending requirements that we've seen in order for these lenders to stay competitive. The silver lining is that it does not appear to be a systemic economic issue. You can see from the chart on your screen there that's showing defaults of a couple different loan types. Defaults really have not picked up. They've stayed relatively contained. If this were a broader economic issue or some sort of indication of economic weakness or weakness in the market, you would tend to see defaults start to rise, and we just haven't seen that. And so what that tells us is that these are isolated examples more so than they are indications of something broader that's going to unfold. The impact that we are anticipating seeing as it relates to the market cycles that I talked about at the top is that we expect that lending standards will start to get a little bit tighter, in particular because these lenders need to account for some of the risk that's there. We don't know where the cockroaches are, but we're assuming, per cockroach theory, that there are more out there. What that means for us specifically, as investors, as we're thinking about how to build portfolios, is that we need to be really cognizant of the credit risk that's in the portfolio. Right now, we are a little bit higher in credit rating than the benchmark, and so we're buying stuff that tends to be a little bit more credit worthy. We also need to be really cognizant of how much we're being compensated. So in the credit market particularly, we're talking about yield. How much are you being paid for the loan that you're giving out? In order to make loans or to invest in debt instruments like bonds, we want to make sure that we're adequately compensated because there is some more risk, albeit isolated risk. There is some more risk in the underlying market right now. So as this continues to unfold, we'll certainly keep an eye on it, but just wanted to make you guys aware of cockroach theory and what it means and what's going on in the credit market.
Great. Thank you, Zach. If you have any questions about anything we've talked about on this Market Carver or any other questions in general, we encourage you to give us a call at the phone number on your screen or use the QR code or website also displayed there. Thank you so much for watching. We look forward to coming back next week with another set of topics for the Market Carver.